Hi guys, Ken from Investing Made Easy here. Today I'll be starting a new series in which I look at a company in depth and work out whether the company may or may not be worth investing in. However, I will try to make the process as easy as possible to follow by giving you an easy checklist to use when deciding whether to invest in a business. Unlike other channels, I won't be giving general, unhelpful advice, but specific advice that can help you improve your decisions when picking companies to invest in. I thought I would start with Intel, as they're a company I am interested in and also have been doing very well in the recent years. This video may be slightly long, as I am laying down the guidelines that I will follow when assessing a company. Before we start, I am not giving financial advice, but merely my opinion on how I feel about the company. Is Intel a gold mine? This is a difficult question to answer. Although the company has performed well in recent years, it does not mean that it will continue to improve in the future. I will give a checklist in this video which you should aim to fill out when thinking about investing in any company. Looking at the stock price of Intel in the past couple years shows a strong upward trend. You can see although there are a few ups and a few downs, the general trend is upwards. Investing in stocks is a long-term investment in which you may need to ride through the downfalls to watch a company grow in the future. The first point is whether you understand the product or the service being offered by the company. This also links well with the second point of how well does the company have an advantage over other companies. Knowing the answers to these questions will allow you to buy shares when you feel like the company has a suitable, long-term product that is better than its competitors. It also gives you the power to know when to sell your stake in the company if you know another competitor is catching up, which will in turn reduce the share price of that company. The third point is about earnings growth per share, or EPS growth. Earnings growth is important as the impact can be exponential. Over 10 years, a 5% EPS growth results in a 63% growth for the company. The figure that I have chosen for my checklist is 7% or above. This is to ensure that the company has suitable growth to see the share price rise in the future. My fourth point is about a low payout ratio. A low payout ratio is important as it shows the company is reinvesting its profits back into the company, which should increase the value of the business in the future. A company which is not reinvesting its profits may find it difficult to grow, as it can fall behind other competitors which did reinvest into research and development. The fifth point is about share buybacks. If a company is buying back its shares, it not only means that the company has extra money to spend. Although this is not always true, the company could be digging itself into debt, but if there are less shares in circulation, the ones that are left become more valuable. It's simple supply and demand. These next few points help us decide whether a company is undervalued. Buying a company that will succeed is great, but if you're paying a ridiculous amount for that share in the company, it could hurt your return on investment period. The sixth point is a low PE ratio. A low PE ratio means that you're paying less for the same number of earnings compared to another company with a higher PE ratio. I chose 25%, as any higher could mean that the company is overvalued. The seventh point is whether a company's dividend percentage is above its 5-year average. High dividends signal that either the company is doing well or it is trying to encourage investors as its shares are undervalued. This means we can snag a good deal on. The eighth point is whether a company has a low PB ratio. Many people use this to decide whether a company is undervalued as it considers many parts of a company. I have chosen a value of less than 3 for this ratio. The ninth point is whether a company has a good credit rating. A good credit rating is essential to make sure your money does not get lost by the company. And finally, my 10th point, never invest on emotion. Always follow your set strategy, as deviating from that strategy and going on your gut feeling gives you less than predictable results. So now we're going to look at Intel specifically. So the first point, do you understand the product or the service offered by the company? So Intel makes consumer and server grade CPU cores for those machines. Intel also makes memory modules and storage modules. That's a couple of the things that Intel does. They also do a lot of other things in the technology realm. So the second part, does the company have an advantage over other companies? At the moment, Intel is a leading developer in the CPU market. There are other companies coming close, but at the moment Intel is far ahead. So yes, the company does have an advantage. The third point, has the company had a consistent earnings growth? As I said, above 7% is around ideal. Intel unfortunately had a 6% decrease this year, which shows they are doing quite poorly with the year-on-year earnings. This could show that it is a bad investment to make at the moment. Looking at the fourth point, does the company have a low payout ratio? Below 70% is about ideal. Intel is currently sitting at around 54%. This is good because it means Intel is investing a lot of money back into their company, so this predicts growth for the future. The fifth point, does the company buy back its shares? Well, Intel currently, the share number of the company decreases by about 1.9% each year. This shows that Intel is actively buying back its shares, which should in turn increase the values of the remainder shares. Now, moving on to whether the company is undervalued or not. The PE ratio, as I said before, should be less than or equal to 25. Currently, the PE ratio is 25.7. This is higher than I'd like to see, and it gives me warning signs that the company may be slightly overvalued. The company's dividend percentage is also below average. The average is 3.17%, but at the moment is only 2.42. This to me also signals that the company may be slightly overvalued and may not be the best buy currently. Right, on to the eighth point. The PB ratio should be less than or equal to 3. Intel's current PB ratio is 3.5. This is also higher than I'd like to see from Intel, and from the 3 points I've seen previously, the company looks to be overvalued. And finally, does the company have a good credit rating? An SP rating of BBB plus or higher is what we're looking for. Intel's current rating is an A plus, so this signals that it's okay to invest in the company. And finally, to wrap things up. So, from what I can see, Intel is a fairly unstable company. There's a lot of ups and a lot of downs, and this is generally true amongst a lot of technology companies. Also, I feel like the company is slightly overvalued at the moment. You're paying a lot for not as much as you should be getting. They are, however, market leaders in a growing industry. Technology is always going to be growing, and Intel at the moment is at the forefront of both driverless cars and home and server gear. So there's a potential for large profits, but a medium to moderate risk. Thank you very much for watching. This is Kenneth from Investing Made Easy. Like, subscribe, favorite, share with your friends. Thank you very much.